Good afternoon from Bangkok. Welcome to Minor International presentation for the third quarter results. As always, we'll start off with the 9 months performance recap and recent updates, followed by the update of each of the business unit, Minor Hotels, Minor Food, and Minor Lifestyle, and finish off with the corporate information. So for the 9 months performance recap, in the first 9 months of 2016, we reported revenue of about 43 billion baht, an increase of 28% year on year. Just a reminder, this includes some of the one-time non-recurring gains that we have recorded over the past 2 years. So just a quick recap of what we've done. In the first quarter of 2016, we've recorded a revaluation gain of the Tivoli portfolio that we acquired of 1.9 billion baht. And in the second quarter, we've also recorded the revaluation gain of the Bread Talk Group in Singapore of 136 million baht in the second quarter. And in the third quarter of this year, just to note on the extraordinary item, we actually recorded gain from changing status of investment in Oaks of 92 million baht, but that was netted off with impairment charges on some of the other Oaks properties. Before tax amount was 132 million baht pre-tax, recorded as part of our SG&A, but after tax, it was pretty much the same amount as the gain. So net came out, it had no impact on our third quarter net profit. Also in 2015, we also had some of the one-time gain as well. We had 650 million baht on the revaluation of the Sun International portfolio in Africa that we acquired, and in the third quarter we had revaluation of about 70 million baht on the Oaks Eland Darwin we bought in Australia. So if you exclude all those one-time items, in 9 months of this year we actually saw a revenue increase of 25% and net profit increase of 11%. So as you can see from the graph, it's primarily from both of our minor hotels and minor food operations. In terms of international presence, today we have 51% of revenue inside Thailand, 49% outside of Thailand. So that is pretty much in line with our 5-year goal to get it to 50-50 in the year 2020. And just to update you a little bit on what we've done in the third quarter to date. So on the hotel side, what we've done for the hotel investment is we've increased the shareholding in 2 hotels in Zambia, Royal Livingston by Anantara and also Avani Victoria Falls. So we've increased the shareholding from 50% to 100%, effective since July of this year. Also, we opened Anantara Kalutara Resort, which is in Sri Lanka. It's an 80% owned property. That was in September of 2016. And we've rebranded one of our key property, which is Pattaya Marriott Resort and Spa. We've rebranded to Avani Pattaya Resort and Spa. So that's part of the our long-term goal of getting the hotels expanding with our own brands. So that was effective November of this year. On the hotel management side, quite a few things as well. In July 2016, we've rebranded and managed 2 hotels. One is Avani Khon Kaen Hotel and Convention Center here in Thailand, and the other one is Avani Deira Dubai Hotel in UAE. And in October of this year, we've entered Oman with our management hotel, Anantara Al Jabal Al Akhdar. This one is in the on the mountain overlooking a canyon, and we also opened later in November of this year Al Balid Resort Salala by Anantara, also in Oman. This one is a beach destination, and on the Anantara Vacation Club side, we added 4 units of inventory. So as of today, we have 151 units by the end of 2016, third quarter of 2016. On the food side, we launched a new concept in Singapore. We franchised the brand Yen Tafo เครื่องทรง by อาจารย์ Malika, and that one has been launched in Singapore. It's a Thai noodle concept. And then for minor lifestyle, we actually launched 3 new brands to continue our strategic portfolio restructuring. So in September of this year, we launched Etem, which is the lingerie brand from from France. In October, we launched Radley, which is a handbag and leather accessories from London. And in November, we launched Anello, which is a backpack and bags from Japan. Now, going into minor hotels, a quick recap on the financial performance. In the first 9 months of this year, on the revenue side, we actually saw an increase of 24% year on year for the first 9 months. Primarily, it's from owned hotels, Oaks, and management contracts. Owned hotels saw the revenue increase by 43%, Oaks by 14%, and management contracts by 16%. It was offset a little bit by the real estate business, which for the first 9 months we saw a revenue decline of 3%, primarily because of the Anantara Vacation Club. And looking at EBITDA increased by 24% for the first 9 months. So we got some operating leverage from the higher profitability residential sales earlier in the year, and also from the Tivoli portfolio in third quarter where it's the high season, so we had the higher operating leverage. In terms of net profit, for the first 9 months, it increased by 11%, lower than the increase in revenue and EBITDA, primarily because of the higher depreciation of newly acquired hotels as we need to ramp them up. Also, the consolidation of Zambia at the revenue and the net profit level, and also the higher effective tax rate as we moved into new regions such as Portugal and Brazil, which have higher tax rates. In terms of revenue contribution, overseas versus Thailand, today in Thailand, Thailand contribute about 37% of revenue, whereas overseas is 63% again. Also, pretty much on our path to the goal of 34% in Thailand versus 66% outside of Thailand. Just quickly on the stats for hotel group. This is for the overall system-wide hotel operation. In terms of number of rooms, we saw increase of 14%, and RevPAR growth of 3%. That's from occupancy of 1% and also the rate of 1%. So that's primarily from hotels in Thailand as well as in Oaks, and together with the impact from the consolidation of Tivoli portfolio in Portugal. And if you look at organic RevPAR excluding FX, it's also up by 3%. Now, going into a little bit more detail on each of the segment. For the owned hotels operation, which account for about 58% of hospitality revenues, today we saw number of room increased by 39%. So that's primarily from the acquisition of Tivoli portfolio in Portugal, and also the opening of Anantara Kalutra, as I mentioned earlier, the increase in shareholding of Royal Livingston and also Avani Victoria Falls. So that's and also we opened Avani Riverside in Bangkok. So those were the main reason for the increase in number of rooms. In terms of RevPAR, if you look at overall system-wide for the owned hotels, RevPAR increased by 8%. So that's from, again, the high season of the Tivoli hotels in third quarter and the existing Thailand portfolio, which actually saw a strong RevPAR increase. So with that, the increased number of rooms and also the increase in RevPAR, if you look at our revenue of owned hotels, in the third quarter it increased by 64%. Now, if we divide the owned hotels into domestic portfolio and international portfolio, we'll first talk about the domestic portfolio first. In Thailand, the contribution is about half of owned hotels, so about 39% of revenue of the overall hospitality business is from our hotels in Thailand. If you look at RevPAR growth, In terms of organic RevPAR in Thailand, we actually saw an increase of 7%. But because we opened the Avani Riverside Bangkok this year, so with the first year of operation, it pulled down the RevPAR a bit. So including Avani Riverside, RevPAR increased by 2% for Thailand. And then if you slice it down a little bit more in terms of Bangkok and in the provinces, in Bangkok, organically, RevPAR increased by 12%, so doing quite well in the third quarter. But because of the addition of the Avani Bangkok, RevPAR for system-wide for Bangkok increased by 2%. In the provinces also continue to be strong, RevPAR increase of 6%, so quite stable over the past few years. So the key destinations that did well included the destinations in the north of Thailand, so in Chiang Mai and Chiang Rai, they've seen good RevPAR growth. Now, turning to overseas, which is another half of the owned hotels, about 29%. If you look at RevPAR of overseas hotels, it increased by 11%. So that's primarily from the hotels in Portugal, as third quarter again is a high season. If you look at organic, excluding the new hotels, RevPAR declined by 6%, so that's primarily from the Brazil and Maldives portfolio. Just a little bit of detail on each of the region. In Portugal, which is almost half of the overseas hotel contribution today, we consolidated 8 months of Portuguese hotels, as you know, we've closed the transaction in about end of January, beginning of February. It's high season in Portugal, so occupancy was as high as about 85%, and the RevPAR growth was about 10% year on year in Thai baht terms. So it's been pretty strong in Portugal. Part of it also is because a lot of key guests, they don't have the option of going to Turkey or Tunisia anymore. So we Portugal as well as Spain have been getting a lot of benefit from that. So we've seen very good volume growth in Portugal this year. Turning to Brazil, as I mentioned earlier, it's a bit soft in Brazil in the third quarter. So we're still seeing the decline in RevPAR in third quarter, but at a lower magnitude compared to the first half. So it's still because of the renovation. We've done pretty much all the room renovation, but now there's still some common area that needs to be renovated. For example, the elevator in Sao Paulo or the pool in Bahia, the beach area. So that together with the weak macro backdrop resulted in slower occupancy. But now we're able to raise the rates because of the renovated rooms. So in the fourth quarter, we're starting to see about flattish RevPAR in Brazil. In the Maldives, again, the portfolio, we're still seeing decline in RevPAR, primarily because of the soft demand, as you know, it's still low season in the third quarter, and also there's a lot of competition as new hotels opened in Maldives. The last market for us for overseas is Africa. Africa, we're seeing consolidation of the Zambia hotels, and as they are close to the Victoria Falls, which is the main tourist attraction in Africa. So Zambia hotels have been seeing double-digit RevPAR growth, and the performance of other hotels in Africa, mainly in Namibia and Botswana, also saw an improvement in the third quarter as well. Turning to Oaks, in Australia, Oaks continue to be a big part of our hospitality business. It's about 22% of our revenues. In terms of number of rooms, increased by about 2% in the third quarter of this year compared to the same period last year. And occupancy is quite stable in the high 70s. ADR is up 7% in Thai baht term, and RevPAR is up 6%. So very stable for Oaks, and continue to the performance continued to be quite stable. So with the RevPAR increase and the room rate increase, Oak's revenues increased by 15% in the third quarter of this year compared to the same period last year. Managed hotels, 4% of our hospitality revenue today. Number of rooms increased by 15%. So we've been opening quite a few hotels over the past 4 quarters. Occupancy is up 2%, ADR is down 6%, and RevPAR system-wide is down 3%. But if you look at organic RevPAR excluding FX impact, it's actually improved by 6%. So that's primarily from hotels in Thailand and the Middle East. With the RevPAR increase organically plus number of rooms, in the third quarter, management fee income increased by 29% year on year. In addition to the performance of the occupancy, ADR, and RevPAR, we also have the hotel expansion pipeline updated for you as well. In 2016, we've pretty much completed all of the hotels in the pipeline that they've pretty much been opened. So we also have the pipeline for 2017, 18, and 19. For invested hotels, we usually open 1 to 2 hotels per year, and on the management contract side, there's more. So that's the updated list. Turning to the real estate business, which is about 14% of hospitality revenue today. In the third quarter of this year, we didn't sell any of the Anantara Layan Phuket, but we're still in conversation with some of the prospective buyers. So hopefully we'll be able to sell either by the end of this year or next year. In addition to the Anantara Layan Phuket, we also have Anantara Chiang Mai Service Suites, of which we have about 44 units. They're much smaller size compared to Anantara Layan. Layan we sell for about $10 million per villa or per unit. But for Chiang Mai Service Suites, it's about 10 to 12 million Thai baht per unit. And we out of the 44 units we have, we pretty much pre-sold about 31 units already. So we're in the process of transferring these units. So hopefully by the end of the year, we'll be able to transfer most of the 31 units and recognize the sales by the end of the year. But also keep in mind that this is our 50% joint venture project. The other one is Torres Rani in Maputo. We're selling about 6 units of the penthouse. We should be able to sell 1 unit this year and maybe with another 1 or 2 units that's still in negotiation. And again, this project is also a 50% joint venture. The last business is Anantara Vacation Club. So Anantara Vacation Club, we're still seeing number of members increase by about 16% year on year in the third quarter of this year. And the main drivers continue to be China, Thailand, Singapore, and Hong Kong. And as we have mentioned earlier that we have restructured the package. So this year is a year that Anantara Vacation Club sales is a bit soft as well as the pressure on the margin. But hopefully next year it will start to take off again, and we should see the revenue and performance improvement in 2017 onwards. Now I would like to turn the presentation to Kun Chayapat for the food business and also the Minor Lifestyle.
Let me start with recapping the financial performance of Minor Food. On this slide, we show the 9-month figure. Core revenue, restaurant revenue increased by 30% year on year from strong performance of Thailand and China hub in particular, and the continued expansion of both owned and franchise outlet together with the consolidation of Minor DKL. Our Australian subsidiaries back in November of last year up until now. And 9-month core EBITDA also improved by about 29% year on year, which resulted in a slight decline in the EBITDA margin from 16.9% first 9 months of the prior year to about 16.7% in the first 9 of this year. And also, if you look at total system sales, we managed to achieve 10% in the first 9 months of this year, led by strong performance, the Pizza Company, Burger King, Riverside, and Sizzler, which report double-digit total system sales growth in the first 9 months of this year. And we still have been very disciplined in terms of expanding our outlets, right on track, roughly about 8% in the first 9 months of this year, with Burger King and Bread Talk, as well as SSP, our restaurant at the airports, seeing the fastest expansion year on year. In terms of same-store sales growth, it's pretty much in line with what we expected for the whole year, about 2 to 3%. We achieved 2.1% in the first 9 months of this year. In terms of net profit, if you look at net profit increase, it grew at a slower rate than revenue. This is due mainly to the increase in minority interest from the consolidation of Minor DKL. Next slide, we show our overseas contribution. Now overseas contribution rose to about 41% of total Minor Food revenue, with 59% coming from Thailand. We still operate under 4 hubs, Thailand, Singapore, Australia, and China. And now we operate in 19 countries across the region under these 4 hubs. And also, there's a potential that we can turn some of the countries that we operate into a new hubs in the future if their contribution is concrete enough. Now let's look at the stats of Minor Food. Well, like I said, Minor Food has a very strong another strong quarter in the third quarter as a result of robust growth from Thailand and China hubs and turnaround Australian hub. Total system sales growth increased by 11.3% year on year in the third quarter from same-store sales growth of 3% together with outlet expansion of 8% year on year. And now the number of outlets has reached 1,928 outlets at the end of the third quarter, increasing by 8% year on year. Roughly about 37% are outside of Thailand and 63% inside of Thailand. And if you look at the split between franchise and owned outlets, 48% are now franchise and 52% are our own outlets. Let's look slice down to performance by hubs. Thailand still account for the majority of the total revenue of our restaurant business, accounting for about 59% of total restaurant revenue in the first 9 months. In the third quarter, Thailand hub maintained strong growth momentum from last quarter with a very solid total system sales growth of 17.5% and same-store sales growth of around 6%. The Pizza Company and Burger King are the star performers or the key brands that drive solid same-store sales growth in the third quarter. If you look at the Pizza Company, it's experienced very strong same-store sales growth of more than 20%, i.e. 21.3% from the success of the crispy thin pizza and extreme crust pizzas that we launched, as well as the special 48 dine-in menus, which are varieties of appetizer, pastas, and drinks. In addition, we also launched some new main dishes in July, and as well as some premium offerings which have been well received by our customers and contributed well to our same-store sales growth. Burger King also reported very good same-store sales growth as a result of their solid performance in tourist location, in this particular quarter. However, the cold chain or dessert category like Swenson's and Dairy Queen's continue to see the impact from the soft domestic consumptions as consumers tended to hold back their spending on light snacks as opposed to heavy meals. So that's pretty much the performance of Thailand hubs. Moving on to China hub, which account for about 14% of total restaurant revenue in the first 9 months. China hub continued to see solid total system sales growth of 22% in the third quarter, with same-store sales growth of 4.4%, and the outlet expansion in particular from Riverside brand, which grew 12% year on year. And note that all the brands in China, including Riverside, Sizzler, and Thai Express, maintained positive same-store sales growth in this particular quarter. Riverside outlets in Beijing see a good performance because the region is more resilient to slowdown of the manufacturing sector in China, while Shanghai is also seeing an improving trend as well. And Sizzler and Thai Express also intend to improve their performance, with Sizzler now focusing more on new product development, as well as Thai Express will try to streamline the supply chain and product consistency. So that's our performance in China. In Australia, which account for about 15% of total minor food revenue, also saw a little bit of a turnaround in the third quarter. They report same-store sales growth of positive 1% year on year, which is the highest in the past 7 quarters, and total system sales increased by 3.7% in the third quarter, as the hubs still remain cautious expanding their outlets amid the weak macro backdrop in the country. But the same-store sales growth, which show a positive 1%, was driven primarily by the performance of the Coffee Club, the largest contributor to the hub. The Veneziano Group also reported year-on-year growth in operation, with increased volume of coffee roasting and also same-store sales growth, which almost hit and also same-store sales growth of another sub-brand of Veneziano, which is Coffee Hit, of almost 10%. Lastly, Singapore hub, which account for about 10% of total minor food revenue, it still continued to be challenged by macro slowdown and high competition in the sector. However, negative same-store sales growth has seen an improving trend every quarter since the beginning of this year. Although negative same-store sales growth and total system sales growth result in high margin pressure in third quarter, Singapore hubs still continue to report profits, i.e. they're still profitable. And with the new management that we sent to Singapore hub since July 2016, Singapore hub is in the process of evaluating the overall portfolio to better segment its Thai food concepts between high-end, mid-market, and casual dining segments. And also, like as Khun Juthadip mentioned earlier, the franchise of Yentafo Kryeong Song by Ajahn Malika, it's also well received by consumers now in Singapore, and it's expected to help strengthen Singapore hub's brand portfolio in the future as well. Moving on to minor lifestyle, which is our retail trading operation. In the first 9 months of this year, revenue from retail trading and contract manufacturing was pretty much flat year on year, while first 9 months EBITDA decreased by 12% year on year because of some promotional discounts, higher sales, and marketing expenses earlier in the year to drive revenue amid the challenging domestic market conditions, as well as some pre-opening expenses to launch new brands of ours. As a result, EBITDA margins declined from 7.7% to about 6.8% in the first 9 months of the year, and profit also declined by 37% year on year, as we show in this chart. Total system sales, we achieved 9% in the first 9 months of this year, with same-store sales growth of 1.1%. And this particular quarter, retail trading doing okay in terms of revenue increase, but it was dragged by contract manufacturing as a result of weaker than expected performance of some of its key customers. If you look at the stats of Minor Lifestyle, same-store sales growth start to see improving trend since the beginning of this year, with same-store sales growth of 3.2% in the third quarter. Outlet expansion and the launch of new brands make the total system sales reach 16.4% in the third quarter. But if you look at sales per square meter, it declined a little bit as we have lower sales efficiency of existing brands in the middle of softer discretionary spending and intensifying competition, and as well as the opening of the new brands like Brooks Brothers, Kojima Denim, and Etham, which are still in their ramping up stage at this point. So that's pretty much summary of the operation performance of our key businesses. Next slides, I would like to recap our balance sheets positions. This is not far different from what we reported in previous quarter. We still have a plan as per our previous 5-year plan in terms of capex up around roughly 40 billion baht, of which 26 to 27 billion baht will be set aside for committed capex, and the remaining 13 to 15 billion baht will be set aside for new investment, new opportunity, and M&A. Note, however, that this number is based on our this year 5-year plan, which was endorsed by the board last October. We're in the process of finalizing the current 5-year plan, which is going to be endorsed by the board at the end of this month. And once we have the new revised or fine-tuned 5-year plan and new numbers, we'll be sharing those numbers with you in later stages. If you look at the leverage ratio in this slide, the gross interest-bearing debt to equity hover around 1.28 times, which is still below our internal policy of 1.3 and far below our debt covenant level 1.75. So if you look at our balance sheet positions in terms of debt positions and equity position, we have a debt outstanding of roughly about almost 50 billion and shareholder equity of roughly about 39 billion. And next year we'll have warrants waiting to be exercised. That will give us another 7 to 8 billion baht by November of next year. This slide, just to recap our 5-year aspiration as per our current 5-year plan. We want to see the number of our hotels increase by roughly from 152 hotels at the end of third quarter of this year to more than 210 hotels by the end of 2020. And number of restaurants from 1,928 outlets now to about more than 3,000 restaurants by the end of year 2020. In terms of 5-year strategies, our strategic pillars remain unchanged, with our goals of that we want to see net profit growth of no less than 15 to 20% per annum on a CAGR basis over the next 5 years, and return on invested capital of no less than 15% over the next 5 years. This will be achieved through 3 strategic pillars. One, we'll try to drive a portfolio of our own brands with additional contribution from selected international brands that we have. But the priority will be our own intellectual properties or our own brands, because they're more profitable. And secondly, we'll try to maximize asset value and productivity of the existing assets we already had by way of doing mixed-use initiatives like residential, timeshare, or an Untitled vacation club, or doing a little bit more on asset light in parallel with asset-heavy business models, and also strengthen our hub and clustering concepts or systems. That way we get more synergistic benefits, and then it will improve our profitability and margins. Lastly, we'll try to expand or increase our growth trajectory through existing and future strategic investment or M&A. So that still remain something that that will drive growth and return going forward. So that's pretty much end our presentation this quarter. If you have any questions, feel free to send it online. First question, I would like to know the trend of RevPAR growth and same-store sales growth in Thailand during October and November, whether it was affected by the mourning period or not. Right after the king passing in October, we didn't really see much impact yet, but starting at the end of October and November, at the beginning of November, we start to see same-store sales growth soften in Thailand during the first week or 2 weeks in November. And also in terms of hotels, we saw some cancellation, but pretty much the postponements of some banquets, some MICE businesses to next year. And we saw occupancy of rooms dip a little bit in November. So that's the trend that we see. And the next question, the organic growth that we set out at 15% in 2017 will come from where? Well, the 15 to 20% earnings target was on a CAGR basis. Some year we probably achieve higher than this, or some year we achieve lower than this, but on average, we want to see 15 to 20% over the next 5 years on average. And the growth will stem from the existing hotels that we already have. We're trying to maximize RevPAR, i.e. strike the right balance of raising occupancy and ADR. That's one. And two, we still prepare the pipeline of our new hotel openings, be it invested hotels or management contract hotels. That, the new hotels opening that come on stream will help drive growth as well. And three, the mixed-use initiatives like residential and an Untitled vacation club, which combined reported as real estate income in our P&L. We also we're going to contribute well in the next few years as well. In terms of food, basically we'll try to drive same-store sales growth and outlet expansion. Same-store sales growth, we want to see at least 2 to 3% per year, and outlet expansion of another 8 to 10% per year. And apart from that, the revenue growth or growth trajectory will probably going to be sharpened by M&A if there's any opportunistically. And we believe 2016, although the mourning period will probably have some impact on our performance and operation in the fourth quarter, but we still confident in the year 2017 that we'll continue to see a strong year in 2017 as a result of maybe a lot of pent-up demand from the mourning period this year. We'll see some improvement next year, as well as some of the turnaround, some of the businesses that we work on today will show some more results next year, as well as the consolidation of the new investment that we made this year or the previous year will bear more fruit next year as well. For example, Tivoli portfolio. Tivoli, it's undergoing renovation. And it's going to go under renovation during the low season at the end of the year and next year. And once the refurb finish, we're probably going to see higher room rates, and that will help drive earnings of Tivoli as well. So that's just one or two examples that we would like to see in the next year or two. So that's another growth driver that we expect to see. So if there's no more questions now, you can send us questions via email, and we get right back to you. Or you can just call us anytime. Our investor relations divisions would be happy to address your concerns or questions. And thank you very much for viewing this webcast today. Thank you.